this session, we shall be working out two comprehensive problems, full-fledged cash flow statement problems, which are probable to be tested in the examinations for 5 marks. One question of 5 marks. So, let us start with this question. Now, in the example that I have taken, there is a fixed asset opening balance to be 8 lakhs, I have 5 lakhs and closing balance to be 8 lakhs. And there is an adjustment regarding that. Rupees 50,000 has been provided as depreciation during the year, and there had been a sale of asset costing rupees 12,000 with a book value of 5,000 for a profit of 60% of the book value. So, we will be opening fixed asset account at written down value method to find out what is the purchase of fixed asset. That will be working note number 1. Working note number 2 will be calculation of profit before extraordinary items. After finishing these two, we shall straight away proceed to the preparation of cash flow statement. Now, working note number 1. At written down value basis, written down value method, particulars. To balance brought down, opening balance of asset 5 lakhs by depreciation. Depreciation provided on the asset is 50,000 rupees by bank sale. Now, cost value is 12,000 rupees, but book value is only 5,000 rupees and profit of 60%. So, 5,000 plus 60% of 5,000 gives you totally 8,000 rupees. Then, by balance carried down, which is 8 lakhs. Then, you have 2 gain on sale of fixed asset, ₹3,000. Therefore, we will get 2 bank purchase will be our balancing figure, which will be 3,47,000. 858. $3,55,000. $8,58,000 is the total. We get bank purchase to be 3,55,000. How are we going to deal with that? This 3,55,000 will be outflow from investing activities. This 50,000 rupees will be a non-cash expense. This 8,000 rupees will be inflow from investing activities, and this 3,000 will be non-operating income. Therefore, that will be subtracted from operating profit before working capital changes. Now, going to the working note number 2. This is working note number 1. Now, going to working note number 2. Calculation of net profit before extraordinary items. calculation of net profit before extraordinary items will be net profit as per balance sheet. Net profit after balance sheet is the difference between closing balance and opening balance. 2,50,000 minus 1,50,000, which is 1 lakh. With that, we shall be adding proposed dividend of the previous year. Proposed dividend of 2017-18, which is 40,000 rupees. So, we got now net profit before extraordinary items to be equal to 1,40,000. We got one working note now. Now we shall be going to the preparation of cash flow statement as per Accounting Standard 3 revised, which is a prescribed format of preparing the cash flow statement. I will also continue here. So, cash flow from operating activities A. Net profit before extraordinary items $1,40,000. With that, add adjustment for non-cash and non-operating expenses non-cash and non-operating expenses. We have only one non-cash expense, namely depreciation. Depreciation on the fixed asset is 50,000. You get 1,90,000. From that, we subtract less non-cash and non-operating income. You have gain on sale of asset, which is 3,000 rupees. So, you get operating profit before working capital changes operating profit before working capital changes to be 87,000. From that, this is going to be D. Then we are going to add with that, we are going to add increase in current liability and decrease in current asset. We have only one current liability which is increasing, trade payables. Trade payables is increasing by 10,000 rupees. I am continuing this side. So, now E is over. F less increase in current asset and decrease in current liability. In this, we have no current liability decreasing, but one current asset increasing, which is inventory. Inventory is increasing by 25,000. So, we get G, cash generated from operations is 1,72,000. H less tax paid net. You don't have any tax at all. Therefore, now we arrive at step number 1, cash flow from operating activities. Our Roman letter 1 we got as 1,72,000. Now going to step number 2, cash flow from investing activities. Cash flow from investing activities. Number 1, proceeds from sale of fixed asset. We got 8,000 rupees. Number 2, purchase of fixed asset. Purchase of fixed asset, we got 3,55,000. So, you get Roman letter 2, cash used in investing activities. Cash used in investing activities to be 3,47,000. So, Roman letter 3, calculation of cash flow from financing activities. Cash flow from financing activities. Number 1, your equity share capital is increasing by 3 lakh rupees. Proceeds from issue of equity shares. You have 3 lakh rupees. Number 2, proposed dividend of the previous year proposed dividend now paid is 40,000 rupees. So subtract that, you will get Roman letter 3, cash flow from financing activities. Cash flow from financing activities to be 2,60,000. So now we have calculated cash flow from operating activities, we have calculated cash flow from investing activities, then cash flow from financing activities. The next step is to calculate net increase or decrease from cash and cash equivalents, which is nothing but 1 plus 2 plus 3. So, number 4, net increase or decrease from cash and cash equivalents. So which is nothing but 1 plus 2 plus 3. So we have 1,72,000 plus 2,60,000 minus 3,47,000. This is going to be our net increase or decrease in cash and cash equivalents. So we got 1 plus 2 plus 3 to be 85,000. So with this, now the step number 5. Step number 5, we are going to add opening balance of cash and cash equivalents. What is given in the question? Find cash and cash equivalents. You have opening balance of cash and cash equivalents to be 2,70,000. With that, we will add short-term investments, which is 3,15,000. 2,70,000 plus 45,000 gives you 3,15,000. So, continuing with this, if we go further, closing balance of cash and cash equivalents, which is given to you as 3,40,000 plus 60,000, which is equal to 4 lakhs. So your cash flow statement is correct. So we have calculated first step, we did working note wherein we calculated the amount of purchase of fixed asset to be 3,55,000. Then we calculated the net profit before extraordinary items by taking the difference between closing balance and opening balance of reserves and surplus, which was 1 lakh rupees. With that, we added one and only extraordinary item given in the question, proposed dividend of the base year, which was 40,000 rupees. So we arrived at net profit before extraordinary items to be 1,40,000. With that, we made adjustment for non-cash and non-operating expense, wherein we had depreciation of 50,000 rupees. Then we subtracted the non-operating income, which is gain on sale of fixed asset, 3,000 rupees. Then we got net operating profit before working capital changes. With that, we added the increase in current liability and decrease in current asset. There was only one increase in current liability, namely trade payable, which was 10,000 rupees. Then we subtracted increase in current asset and decrease in current liability. Only one increase in current asset, which was inventory, by 25,000 rupees. We got cash generated from operations to be 1,72,000. With that, we try to subtract the tax paid, that is the net of tax paid. This problem, we did not have tax at all. Therefore, we got cash flow from operating activities to be 1,72,000. Then with the help of the pre-calculated information, we calculated cash flow from investing activities. We got inflow from investing activities to be sale of machinery, 8,000 rupees, and outflow from investing activity to be purchase of fixed asset, 3,55,000. So we got the net cash used in investing activities to be 3,47,000. Then we went in for calculation of cash flow from financing activities. There is an increase in equity share capital, which is inflow from financing activities, and there is payment of dividend of the base year during the current year, which is 40,000 rupees. So we got cash flow from financing activities to be 2,60,000. Then we went to the step number 4, calculation of net increase or decrease in cash and cash equivalents, which is 1 plus 2 plus 3. So 172,000 plus 260,000 minus 3,47,000. We got net cash increase or decrease from cash and cash equivalents to be 85,000. With that, we added the opening balance of cash and cash equivalents, which is given cash and cash equivalents as 2,40,000 to 2,70,000. With that, we added the short-term investments, which are also considered to be cash equivalents only. So the total comes to 3,15,000. With that, we add the 1 plus 2 plus 3, which is 85,000. We are arriving at closing balance of cash and cash equivalents, which is also given in the question to check whether your answer is right or not. Cash and cash equivalents 3,40,000 plus the addition of short-term investment 60,000 rupees. So your final answer is 4 lakh rupees, which is closing balance of cash and cash equivalents. So this is a full-fledged comprehensive problem. Now we shall do one more comprehensive problem. Now in this question, you have fixed asset, tangible fixed asset to be 9 lakhs and 12 lakhs, and there is only one additional information about fixed asset, that depreciation charged during the year is 1,20,000 rupees. So we shall now prepare fixed asset account to know what is the purchase of fixed asset. Then we shall be going to working note number 2 about calculation of net profit before extraordinary items. Now in the given question, we don't have any short-term provisions at all. That means there is no proposed dividend or provision for tax given in this question. Quite a simple problem to do. So at the maximum, you should be able to solve this type of problem in a span of about 5 minutes. That is the board prescribed time limit for a simple question like this. Fine. Now going to working note number 1, fixed asset account. Following written down value basis. We have to balance brought down, opening balance of fixed asset is 9 lakhs by depreciation. Depreciation given in the question is 1,20,000 rupees by balance carried down, which is the closing balance, which is 12 lakh rupees. So now we shall be having on the credit side 13,20,000. Then, so you will get the balancing figure as to bank purchase to be 4,20,000. So, this 4,20,000 will be outflow from investing activities. This depreciation of 1,20,000 will be treated as a non-cash expense. Now, we shall be going in for working note number 2. Calculation of net profit before extraordinary items. Net profit before extraordinary items. You have net profit for the year. As per the balance sheet, there is no other information. So it says profit and loss account balance. Now you find that opening balance is 4 lakh rupees and closing balance is 3,50,000 rupees, which means there is a loss. There is a loss for the current year. So 3,50,000 minus 4 lakhs, which is 50,000 rupees to be loss for the year. Now, going to the preparation of cash flow statement as per AS3 revised. So, cash flow statement of Christie Limited as per AS3 revised. Now, I am starting with 1. Cash flow from operating activities. We are going to calculate cash flow from operating activities. We have with us net profit before extraordinary items. We had a loss of 50,000 rupees. With that, we are going to add adjustment for non-cash and non-operating items. Non-cash and non-operating expenses. In that we have depreciation 1,20,000. Number 2, interest on long-term borrowing, which is given in the question 36,000. So, you get, there is no non-operating income. Therefore, we have no other item to subtract. So, we should be arriving at operating profit before working capital changes. Working capital changes 1,56,000 minus 50,000, we will arrive at 1,06,000. Now with that we will add increase in current liability and decrease in current asset. Increase in current liability and decrease in current asset. So, there is no decrease in any current asset, but there is an increase in trade payables by 10,000 rupees. Trade payables is increasing by 10,000 rupees. Then, less increase in current asset and decrease in current liability. So we have increase in inventories, increase in inventories 1 lakh rupees, and 2, trade receivables is increasing by 80,000 rupees. So 1,80,000 minus 1,16,000, you will get cash generated from operations. Cash generated from operations to be unfavorable 64,000. This will be F. Now G, less tax paid net. There is no tax paid at all. Nil. You arrive at Roman letter 1. Cash used in operating activities. To be 64,000. Now, number 2, cash flow from investing activities. Cash flow from investing activities, we have purchase of fixed asset, $4,20,000. There is no other inflow or outflow. Therefore, Roman letter 2, cash used in investing activities. Cash used in investing activities is 4,20,000. Step number 3, cash flow from financing activities. Cash flow from financing activities, proceeds from issue of equity shares. Equity share is increasing from 8 lakhs to 12 lakhs. So, increase by 4 lakh rupees. Then, you have long-term borrowings increasing from 3,50,000 to 4,40,000 rupees. So, proceeds from long-term borrowings ₹90,000. Number 3, payment of interest on long-term borrowings, which we have already added as non-operating expense. Now we shall be subtracting that, which gives you 36,000. So you have Roman letter 4, cash flow from financing activities. Cash flow from financing activities to be 4,54,000. Now Roman letter 5, 4, net increase or decrease in cash and cash equivalents will be 1 plus 2 plus 3. So you have unfavorable 64,000 plus unfavorable 4,20,000 plus favorable 4,54,000. So you get an unfavorable 30,000. Step 5, add opening balance of cash and cash equivalents. $3,70,000. So we arrive at step number 6, closing balance of cash and cash equivalents. Cash and cash equivalents, which is 3,40,000. So we are able to solve one full-fledged cash flow statement after making all these adjustments. So we started with an unfavorable balance of 50,000 rupees in the profit and loss. Then we did not have any extraordinary item. We added the non-cash and non-operating expense, namely depreciation and interest. We arrived at operating profit before working capital changes. With that, there was an increase in current liability we added. We did not have any decrease in current asset. Then we subtracted increase in current asset. We arrived at cash generated from operations. Then we did not have any extraordinary expense, that is outflow from tax, etc. Therefore, we got cash used from operating activities to be 64,000 rupees. Then by preparing the fixed asset account, we already got the information about the purchase of fixed asset, which is 4,20,000 rupees. Then we found cash flow from financing activities. We have an increase in equity shares by 4 lakh rupees, increase in long-term borrowings by 90,000 rupees. Then we had an outflow from financing activity, payment of interest. So net increase in cash flow from financing activities, we got 4,54,000. Then we added 1 plus 2 plus 3 to arrive at net increase or decrease in cash and cash equivalents. We found that there is a decrease in cash equivalent to the extent of 30,000 rupees. With that, we added the opening balance of cash and cash equivalent, which is 3,70,000, to arrive at closing balance of cash and cash equivalent 3,40,000, which is your answer given already in the book. So we are matching the answer. We are correct now in our procedure. The next problem we shall be seeing about the accounting treatment of provision for tax and other things. Namaste.